Neil, what do you think about that? The 2,800 on the S&P, it's going to be hard to continue that Goldilocks scenario.
Yes, I mean, I would agree. I think the fact that the markets have now priced in the Fed reducing rates through 19 and into 2020, I find curious, because if we need the Fed to start cutting rates from an albeit very low level, that would suggest to me that they are implicitly worried about the prospects for the US economy and corporate earnings, in which case I'm wondering why we're reaching all-time highs. I think one has to be careful what one wishes for here.
Well, it's the perennial question, really, which is right, the bond market or the stock market? Because when you have the 10-year down south of 2.6%, it's hard to reconcile that with a skyrocketing equity market.
I agree, but I think where the sentiment has changed is in the equity market. The equity market was very nervous running into Christmas. Some of those fears are still there, the regulation of the FANGs and the political interference as well. But I think the bond market hasn't changed its view that the world looks a fairly tough and dull place, which we would agree with. But the equity market, I think, probably fueled by share buybacks, some M&A, is maybe feeling that the joys of spring, and maybe when we look through into summer, they'll realize that maybe we've seen corporate earnings peak.
But if indeed there's a disagreement between the bond market and the stock market over what the Fed is doing, is it over what will happen? That is to say, how dovish or hawkish the Fed is, or is it over whether it really makes that big a difference?
Well, I think that's a good question, David. I think the two ways I would look at it is if the bond markets are right, and therefore the markets are right to be pricing in a Fed cut, as we'll see with the next set of corporate earnings, maybe we're going to start seeing disappointment and lower guidance, which would then challenge the valuation of the equities. Whereas if the equity market's right and the president is right and the US economy is still fine, and after a difficult Q1 we're going to be reaccelerating, then we have to price back the Fed to 2 or 3 rate rises, and we know what that looked like in Q4 last year. The equity market didn't like it.
No, fair point. On the flip side, though, what's going to be the bar for another decline in rates? Like, why wouldn't this be the bottom?
Well, I think to see a decline in rates, I think we have to see the US economy continue to lose momentum, which, there's clearly been a loss of momentum in Q1. I think people are optimistic that we'll have a bounce in Q2. I think the politics, to one of your earlier guests, will also begin to raise its ugly head as we look into particularly some quite socialist, left-leaning candidates from the Democratic side, who clearly would not be good for capitalism and for the for US markets. But I would also argue that the Fed will only really turn, I think, if they see the US equity market have another sustained fall. So I think we're very precariously placed, both from a sentiment perspective and also from a fundamental perspective.
What about for overall vol then? Are we just going to see lower vol continue across all asset classes?
Well, I think, Alex, it's a very difficult thing to answer, because I think what we've learned in the last 7 or 8 years is when the central banks get involved, they seem to be able to suppress vol. Whether with the leverage in the global system, more quantitative easing or more interest rate cuts will actually make us all feel that it's all still okay, I think is going to be a very difficult one for us as investors. What I would say about Asia, Japan and Europe, though, is most of those equity markets are priced for a recession.